Wall Street reacting to day 4 of the war, and at one point this morning, the Dow was down more than 1,200 points. But like yesterday, it rallied from there somewhat, still finishing down just over 400 points. The NASDAQ and S&P 500 both rallying from 4 slight gains on Monday, and while they did rally from lower points today, both of them finished in the red as well. The S&P just under 1 percentage point, the NASDAQ just over 1 percentage point. But could it take some time to feel the impact of what's happening in Iran on our wallets? Iran saying it will not allow oil to travel through the Strait of Hormuz, and if they make good on that promise, it's going to drive oil prices even higher, creating more uncertainty in the markets. Ross Mack is a Wharton School of Business graduate and former Wall Street analyst. We visited with him earlier this afternoon before the markets closed to find out what we consumers should be watching for as this war plays out. So Ross, let's start with this. A lot of market volatility, obviously. Today, the Dow dropping at one point 1,200 points. At the time of this interview, it's trying to rally back. Yesterday, everything started down and then rallied a little bit. Is this kind of typical for market reaction to a military campaign?
Absolutely. Well, one, thanks for having me, but absolutely right. I think one thing people need to understand is anytime there's big headline news, the stock market hates uncertainty. And so what you have is real early on in the morning, you have people trying to digest just exactly what's going on. And as a result, most people are going to be risk off, meaning that they're selling stocks, they're selling their assets. And as a result, you're nine times out of 10 going to see a lot of red. And then as the day goes on, people start being able to finally digest. However, what we're talking about is that initial form of uncertainty. And now you have the ability for people to start saying, okay, how long is this going to persist? Which companies are going to be most impacted? What does this do for the overall economy? And that's kind of what you're having right now.
So what would your advice be to people that want to peek at their 401ks right now? Should we just kind of like back off and let this play out a little bit?
Yeah, I got one word, right? Don't. I think, when you're looking at what your 401k is, you got to understand, right? This isn't about looking for, any type of daily swings, right? That is obviously emotional. You need to understand that your retirement planning is strategic and is obviously more long-term. And so when you're looking at your 401k, you have the ability to get, to fall susceptible to all the emotions. And unfortunately, you have some people that actually might want to sell. And unfortunately, all you're going to do is realize those losses. What I recommend is, continuing to dollar cost average, aka continue to invest every paycheck or so, or every month or so, and that's generally what your 401k is. But I think on days like now, right, you don't look at it, right? If we were to rewind a year ago when Trump originally got into office, and there was a lot of talks about imposing tariffs on pretty much everyone, what you have was similar moves to what's going on, and the exact same thing happened, right? You had the market trying to digest what's going on with a ton of uncertainty. And if like I know, the market last year started down red, and obviously the market ended up over like 16% last year. So, I always tell people remain a long-term investor.
Ross, let me ask you this, because it's an election year and affordability is going to be a hot topic. We heard it last week in the State of the Union and all the reaction coming out of the State of the Union. How long typically does it take for this kind of market volatility that we're seeing in reaction to what's taking place in the Middle East? How long typically does it take for that to trickle down to what we all understand as affordability?
Yeah, I think it could take weeks, right? And, it depends exactly where we're saying. So let's just talk about it kind of from a timeline standpoint. The moment the war happened, we saw oil spike. And we got to understand that oil is pretty much the driving force in, economy, because it is a large input to manufacturing and production. And as a result, when those manufacturing and production bills end up going higher, well, guess what? You have these businesses passing on those prices to the end consumer. So now, like I say, it could take weeks. However, we could probably in the short term start seeing gas prices creep up. Now, when it comes to, different companies that are getting or importing goods that are actually more susceptible to manufacturing costs and a rise in spike in oil prices, then you might start to see some of these people say, okay, let's increase prices at grocery stores, and let's increase prices at, the Walmarts and the Targets of the world. And so I think that on a short in the short term, right, oil spikes, stock market's down, right? People are panicking, but I do think that we could in the coming weeks potentially see gas prices go higher, and then ultimately we can see, other prices being higher as well. And so, a long-winded answer of me saying it is that it could be within weeks.
Let me ask you this, because one of the other things that rose yesterday, and I don't know if this is surprising because I'm not an economist, so I'm going to ask you. Mortgage rates went up yesterday. They had finally dipped below 6%, but yesterday they jumped back up above 6%. Why are those two things tied together?
I love it. We talked about it, right? So to your point, right, this isn't customary, right? Generally speaking, when there are times of uncertainty, you have two things. It's either risk off or risk on. And what you have in a scenario where there's uncertainty, you have risk off. So you have investors buying bonds, selling stocks, buying gold, right? And so generally speaking, if investors are buying bonds, what you would have are interest rates going down. And so now we're talking about mortgage rates, which is generally tied to the 10-year mortgage, to the 10-year treasury. So generally speaking, we should see 10-year bond rates going down, right? However, anytime there's much more uncertainty, and when we see energy prices going higher, and the outlook is that inflation is going to remain persistent and it's actually going to elevate, then what you have are those rates actually going higher. So what we had in this instance was a risk-off standpoint where investors weren't actually buying bonds as much. Instead, they were buying gold.
Ross, we appreciate the time. Thanks so much. Thanks for doing this.
Thank you so much. Thanks for having me.